Welcome to my Tesla video. We're going to be diving deep into the EV company's financial statements and stock performance. From skyrocketing stock prices to groundbreaking technology, it's no secret that Tesla is changing the game when it comes to the automotive industry. But how does their financial health stack up against traditional automakers? Today we'll be comparing ratios and examining trends to give you a comprehensive look at the financial health of Tesla. Let's get started with the model. This is a large cap company, 616 billion market cap. They're trading at $195 a share and they have 3.2 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So their free cash flow grows a lot, from 1 billion way up to 7.5 billion. It doubled from 2021 to 2022. Net income is the profit or loss on the income statement. It's revenue minus expenses. And they had a loss in 2019, a gain of 860 million in 2020. It jumped up to 5.6 billion, then way up to 12.6 billion in 2022. Revenue is the sales for the company, and that grows a lot, from 25 billion way up to 81 billion. This is their income statement. The top line is the revenue, the sales. They had 81.5 billion in 2022. Let's dig into that number a little more so we know what it is. Here's a breakdown of their revenue from their 10K, 2020, 2021, and 2022. Of the 81 billion of revenue, 67 billion was from auto sales, 1.8 billion from regulatory credits, and 2.5 billion from leasing. They generated 4 billion from energy generation and storage. This category includes the sale and lease of solar energy generation and energy storage products. An example of this are solar panels on someone's home. It also includes financing solar energy products. And they generated 6.1 billion from services and other. When you first buy a Tesla, it's usually under warranty. But if you own it for say 5-6 years and you go back to Tesla to get it fixed, that's part of this category. So non-warranty services and parts. Here's a breakdown of their revenue by country. In the US it's 41 billion, almost exactly half their revenue. China's 18 billion, and every other country is 23 billion. And every year it goes up in all categories. Let's go back to the income statement. Below revenue is the cost of revenue. These are all the expenses directly related to generating the revenue. An example of this is the cost to make a car. Revenue minus cost of revenue gives you your gross profit, and that went up from 4 billion to 21 billion. Then you have your operating expenses. These are all the expenses not directly related to generating the revenue, such as marketing. Gross profit minus operating expenses gives you your operating income. It more than doubled from 2021 to 2022, while their revenue did not double in that same time frame, so their margins are getting much better. They received 300 million of interest on their investments. They paid about 200 million of interest on their debt. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. It looks like they had a loss in 2022. That's likely an asset impairment. Below that is their pre-tax income, their taxes, and the bottom line of the income statement is their net income. It looks like their taxes are pretty low. It's under 10%, because 10% of 13.7 billion is 1.4 billion, and their taxes are 1.1 billion. So it's about 9%, maybe 8%. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So their cash flow is up a lot, from 2.4 billion in 2019 to almost 6 billion to 11.5 billion to 14.7 billion. They do spend a lot on CapEx since they're a manufacturing company. Every time they build a factory to make cars, that goes into CapEx, and that dollar amount is carried on the balance sheet and depreciated over its useful life onto the income statement. Operating cash flow minus CapEx gives you your free cash flow. They have lots of free cash flow. They do not pay a dividend. Let's look at the capital structure. 45 billion of equity, 6 billion of debt. They're 89% equity, 11% debt. And they could pay off all the debt with the cash on their balance sheet and still have 16 billion of cash left over. I gave them the middle whack on Finbox, 11.3%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $300 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $240 billion. We divide that by 3.2 billion shares. And we get a calculated stock price of $75. They're trading at $195, so they're trading at a 160% premium. It's a sell according to the model. 23 analysts projected their revenue in 2025 to be $164 billion. The projection for 2024 is $134 billion. For 2023, it's $103 billion. I continued this trend into 2026 and I got $194 billion. That's how I got their future revenue estimates. They don't convert that much revenue into free cash flow. The most is in 2022 at 9%. They converted 9% of their revenue into free cash flow. So I multiplied their future revenue estimates by 9%. That's how I got their future free cash flows. The website Simply Wall Street values them at 156. They're saying it's 25% overvalued. 31 analysts priced this stock and the average price target is 220. The low is 120, the high is 300. Another 32 analysts priced this stock and the average price target is 211. As we all know, the stock really took off starting in 2020. It went up like 10x from the beginning of 2020 to the end of 2021. But it did come down a lot. It was down 60% or 70% at its worst. It has come back up from the bottom. It's probably up about 50% from the bottom. But I'm not sure if it's ever going to get back up to where it was. They'd have to sell an awful lot of cars. Obviously, in the past 2, 3, 4, 5 years, this stock is up so much more as a percent than the other automakers. But in the past year, this stock is doing the worst, down 46%. Stellantis is up 11%, GM down 16%, Toyota down 21%, and Ford down 24%. They have a pretty high beta, 2.07, so the stock is really volatile. It moves 2 times the market. It's down 46% in the past 52 weeks, while the S&P is down 9%. The 52-week low is 102, the high is 384. And the stock is trading between its 50-day and 200-day moving average. This is a really popular stock. About 150 million shares are traded each day. Of the 3.1 billion shares outstanding, 2.7 billion are on float, 45% are held by institutions, and 3.3% of the shares are shorted. They've done 2 stock splits, a 5-for-1 in 2020 and a 3-for-1 last year. If you put $10,000 into this company 10 years ago, you would have been over $1.3 million at one point at the end of 2021. But if you're still holding on, you'd have $740,000. That's a 54% annual return, a 7,300% total return. In the past year, there's only been insider selling, no buying, all by Elon Musk. And he sells lots of shares, 22 million, 20 million, 23 million, 15 million, 13 million. I think part of the reason for all these sells are to pay taxes. 43% of the companies held by institutions, 42% by the general public, 15% by insiders, and 0.04% by the government. They've been adding lots of employees since 2020. They're at 128,000 people. Elon Musk is the biggest shareholder at 13%. His valuation is $80 billion. It was like $250 billion at its peak. Vanguard owns 7%, then BlackRock, State Street, and Capital Research. The best way to look at ratios to compare them to companies in the same industry. There are 57 companies in the same industry as Tesla, and if Tesla has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they spend a lot more than average in CapEx. They have a really good debt to equity ratio. They do not pay a dividend. They generate lots of free cash flow. Look at Stellantis, over 12 billion. Honda, over 15 billion. They're by far the biggest company on this list, although they were over 1 trillion market cap at one point. They don't have good ratios. Their price to book, PE, and price to free cash flow are worse than average, although their price sales is better than average. But look how much better Stellantis is, or even General Motors is, than Tesla. They generate lots of revenue, but a lot less than Toyota, Stellantis, General Motors, and Ford. Their 5-year revenue growth rate is really high, 47%, but I have a feeling that's going to come down, and they have a good ROA and ROE. So to summarize, I have them trading at a 160% premium. Is it a good time to buy Tesla? It is down a lot. It's a much better time than buying it a year ago, I'm sure a lot of people would argue against that. They just face so many hurdles, and the margins aren't that great in automobile manufacturing. So I think you may have missed a boat on Tesla, but I've been wrong before. I ranked their free cash flows and revenue 9 out of 10, their ratio is 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.